My name is Michael Duke, and this is the show where I analyze stocks that are interesting. So, if you're interested in that, plus content about markets, business, investing in general, then please consider liking this video and subscribing to my channel so you see more of it. Today, we're going to be revisiting Philip Morris International stock, ticker PM. This is one of the first tickers that I covered on this channel. Most of the work that I have done is the initiation of coverage and analysis on that particular stock. One thing that I'm currently working through and figuring out is how best to arrive back at kind of an update analysis of a particular stock. So I've done one of these videos about Hershey, this one about Philip Morris now. So what we're going to do is we're going to review a little bit of what I originally brought up in my initial video and article about this stock, and we're going to take a look at the most recent earnings report and see how we're doing, see if this the thesis is playing out as we expect. As always, it's worth noting that the analysis presented in this video and all my videos is my opinion, and it is not financial advice. It is not a recommendation to buy or sell a particular security. Also, you see here, I am a contributing analyst on Seeking Alpha. Uh, I use it to perform a lot of my analysis, as you see in my videos. I strongly utilize the platform while I'm doing my analysis and in my own time working on analyzing my own portfolio metrics and whatnot, taking a look at new stocks, finding new investments. If you are interested in utilizing the platform for your own benefit, then I do have a link whereby you can get 30% off your subscription to Seeking Alpha Pro or Seeking Alpha Premium. Anyways, let's dive in to Philip Morris. And one thing I'm going to do here is I'm going to kind of check in with my initial thoughts on the stock and see how we're doing. So, this article was written by myself, published on November 24th, 2024. You see, I graded the stock a strong buy. Since then, we have a total return in excess of 20%, whereby the S&P 500 is down 5%, greater than 5% in that time. So we have crushed the index by over 25%. This stock represents the largest individual position that I have in my entire investment portfolio. It comprises about 12% of my entire portfolio. I put initially about 9-10% of my portfolio in it. It's, of course, up quite significantly. And here and there, I've actually accumulated a few more shares, but presently it is by far the largest holding that I have. And there's several reasons for that. Obviously, given where I'm coming from, I believe that it was a very strong buy, and I gave that synopsis in November. But is it still a good opportunity, and is the thesis playing out as much as the share price would suggest? Well, let's take a look. Our thesis, and I will read verbatim here just to start us off. This is a wide moat stock with defensive qualities that should do relatively well in weak broader market declines, with a fast-growing segment of new products that provides it with more long-term growth potential than most value stocks. While some companies today, think midstream pipeline operators or utilities, trade at higher yields and lower valuations, the stock arguably has the highest dividend of any in the market, with its economic moat and intangible asset characteristics. They're in a prime position to accrete value for shareholders for years to come at a best in sector pace. This is important. While competitors are focused on buying back stock and unloading equity, stakes to shore up capital. Let's focus on this first part. Wide moat stock with defensive qualities that should do relatively well in weak broader markets. Let's take a look at if that has been true. First off, we want to note here that the Seeking Alpha Quant, which has been a pretty reliable indicator of future performance, has grades this a strong buy currently. In fact, it has graded it a strong buy really since a few weeks prior to when I wrote my initial article. Several times throughout the last few years, it's graded it that way. It's turned out to be a pretty prescient indicator in each time. Let's take a look at how the stock has done and if it adheres to what I claimed, that it should do well in a broader market decline. Well, obviously, what do we know about what's been going on as of late? Well, we know that the S&P 500 is down year to date. We see here it's really since mid-February, about a month ago, the broader index has sold off by about 10 points. We see here that Philip Morris has, in that same time, actually traded slightly up. Notice the volatility here and the volatility here. They just crushed each of their last two earnings reports. We'll take a look at the most recent one. That's the volatility there. But a couple of things I want to highlight. Key divergence here. The stock has sold up in periods when the index has sold down. While it is not exactly inversely correlated, I think it is safe to say that that ended up being true, that the stock has indeed outperformed in the current period of market weakness. Tobacco stocks are notorious for their defensive qualities. I think tobacco stocks are notorious for their defensive qualities. However, one thing that I argued in my prior analysis was that this tobacco stock is superior, best in breed. We see here that indeed Philip Morris International has strongly outperformed Altria and British American Tobacco year to date, almost doubled up those returns over the last 6 months. All three stocks have performed very well. But again, Philip Morris leading the pack in terms of exceptional performance. We see here over a year-long time frame, it has outperformed. Over a 3-year time frame, it has outperformed. Over a 5-year time frame, it has outperformed. Over a 10-year time frame, it has outperformed. In fact, it has outperformed the broader market over 10 years, while the other two stocks, sadly, have not. However, we do see here within the last month that Altria has in fact performed better. So that's notable. Okay. So the stock has performed exceedingly well in the time since we last reported on it. Turned out to be one of those calls that goes your way. Sometimes they do, sometimes they don't. So let's talk about the the whole core element of my writing here. Market dominance in smoke-free products driving a compelling growth story. Really, the thesis here is simple: that not only as a tobacco stock is this company in really prime position right now to outperform, given a lot of the uncertainties in the market, but it also is the best tobacco stock, and the reason for that being that it is the market leader in smoke-free products. And just to illustrate some of this, we will now take a look at their most recent earnings, dated February 6th. We are a little bit late. That was 40 something odd days ago that this occurred, but let's just take a look and just some gentle foreshadowing here, folks. These numbers look really, really good. Okay. Goes without saying, but very strong organic top and bottom line growth across all categories. Fourth consecutive year of total volume growth. Here, One common theme, especially especially for Altria, is that most tobacco stocks have not seen volume growth in recent years. They've seen volume declines. In fact, um, while these companies continue to increase profits, it is largely because they continue to increase pricing to offset their volume declines. That is not the case for Philip Morris, as for 4 years in a row, they are seeing volume growth. And part of the reason is they are basically operating worldwide, with the exception of China. And you see some markets have increasing cigarette volumes. So, right off the bat, that's an advantage that this company has over Altria, for example. Continued IQOS, or heated tobacco units, growth momentum, increasing profitability. ZYN, sequential volume acceleration, that's an understatement. Even their combustible or cigarette portfolio is showing revenue and profit growth. 15% organic operating income growth, 10% in dollars. That led to 9% dollar adjusted diluted earnings per share growth. Very strong growth for a tobacco company. So let's take a look here. 10 years of smoke-free transformation. These are adjusted net earnings, excluding snuff leaf, and U.S. chew. Smoke-free net revenues. So 2015, we had 200 million. Okay. We now have almost 15 billion of revenues from smoke-free. So what is that? 30 times? Pretty good. This is key right here. FDA authorization for all ZYN products currently marketed by Swedish Match in the U.S. Fiscal year versus the prior year. Good growth. 3% shipment volume, but 10% revenue growth. So they are able to push pricing in excess of inflation. Operating income up 15%. Currency neutral adjusted earnings per share up 15%. Adjusted for currency up 10%. So a lot of 2024 saw a strengthening dollar. That is reversing somewhat right now, which is a tailwind to this company's earnings. You see here that a strong dollar is a headwind for Philip Morris. That makes it interesting. That's something that I didn't really cover in the last analysis, and I want to discuss this time. So right off the bat, you see here in 2024, as we are seeing greater and greater revenues from the smoke-free portfolio, we're seeing accelerating revenue growth, almost double-digit revenue growth. And again, 15.6% currency neutral income growth, profit growth. Here's what's interesting. So we see revenue growth of the smoke-free products, 17%, and gross profit growth, 23%, excuse me. Gross margins up for both smoke-free and combustibles. Really strong results. You see cigarettes are up, heated tobacco units are up, oral or ZYN up. Very, very strong. 38 million users of smoke-free products. We see here, you just really catch on to the incremental growth. The first half of 2021, we were at 20 something odd million. We're at 38, almost 39 million right now. Almost a double in 3 years. That is insane. What a period of history it is to see such growth from a tobacco stock. It's just a beautiful thing to see. IQOS, interesting numbers. They had this in their prior report. These are our, market share in each number. You see here in every single city except for Warsaw, we had increasing market share of heated tobacco units. Almost every single market there. Multiple points in every market except for Stockholm. Stockholm, of course, and Sweden is kind of the birthplace of smoke-free products. So there's a lot more different types of products there. IQOS performance excellent in Japan. I really love how focused the management team is on market share. It's very key. I love their transparency here. And then these are kind of ex Europe and ex US markets here. We see again market share growth, multiple points in most markets. The only one declining listed here being Cairo. This again, as somebody who's much more familiar with ZYN than IQOS, this is what I know more about. US shipment volumes, we went from 149 million to 165 million quarter over quarter. That is 16 million over, so that's double digit growth quarter over quarter. That's like 40+% compound annual growth. Okay. That's how much we're growing right now. Very, very strong. Here's another thing to note. Okay. Nicotine pouch category volume share. One thing that we have to take into account is what happened here. Well, if you attempted to buy a ZYN pouch here, you understand that they were impossible to find. There was a shortage of product available, and that did result in some share gains from some of the other competitors. They couldn't make the stuff and distribute it quick enough for demand. But you see what's happening here. Share is rebounding as they stabilize the supply. So that's very good to see. Of course, we know that they are building out their large production plant in Colorado. Obviously, we see that the supply constraints, really damaged their volume growth. However, we are seeing a return to leading share gains here. We see the light blue being the ZYN brand, dark blue being the nicotine pouch in the US's. A light blue number being higher means market share growth. We see a return to market share growth in the most recent quarter. Very positive. International nicotine pouch shipment volumes, we have a 9.6% growth versus the prior year, or 9.6 million cans quarter in the quarter 20. So it's growing super quick. They say 75% growth versus prior year. That, I think 2023 was a partial year because they purchased the brand in 2023. So that number might be overstated somewhat. And then here we're talking about combustible. You see that they're growing. They continue to push pricing in combustibles, much like other brands are. Gross profit up 7%. They're saying that shipment volumes total, very modest increase, but smoke-free products 12 to 14% volume growth. Heated tobacco. So I'm not quite sure what IMS means. International market share, internal market share, offtake share, intake share. Very complex grouping of market share information. Either way, they're projecting heated tobacco unit growth 10 to 12%. They're saying that ZYN shipment volume 780 to 820 million. So that corresponds roughly to 6 to 8% top line growth. Wow, that's really good for a company like this. Adjusted operating income growth 10.5 to 12.5%. Adjusted diluted earnings per share growth matching, and then currency adjusted 7 to 9%. That's really strong. The thesis that we discussed here, when it came to the initial article about this company, was that it would outperform during a period of poor market performance. We see that that's been true. We also opted to explain how it was the superior tobacco stock. That's also been true, borne out in the performance. In terms of the risks, right here we're talking about the primary risk of the company, and I might rethink that. The primary risk, major risk is currency risk. Majority of sales outside the U.S. Revenues derived in weaker currencies. So a strong dollar is a headwind for this company. Well, what we're seeing as of late is the dollar is weakening somewhat, not a lot, somewhat, and that is a tailwind to earnings. I think it's fair to say that if the dollar were here, you see here that they're actually projecting that there's a strong dollar uh, regime over the next year. I'm not so sure about that. So I actually think that this risk here, the currency risk, is going to surprise to the upside. Okay, this year. And then, of course, the other risk being that you have just the combustible risks, the litigation risks around combustibles, declining volumes, all that. We see that PM has largely bucked that trend so far. So I think what we need to talk about is we need to talk about the current growth and the current valuation to assess whether we might still find it to be a good opportunity. All of these grades are going to be relative to consumer staples, not just other tobacco stocks, but consumer staples in general. Um, One thing that I do want to point out here is that the company is not only growing faster than the other tobacco stocks, but is growing faster than consumer staples. Um, for those of you that have been paying attention, you know that I really like Hershey stock. Hershey is not a stock that's growing at all. In fact, it's contracting right now. Um, Whereas this stock here, very much the opposite, right? Hershey, of course, being considered consumer staples for the purposes of this categorization. So here's our sector median numbers here. We see here that Philip Morris really outshines the category in just about every single instance, particularly in terms of operating cash flow. But we see here that the median earnings per share forward growth rate, high single digits, whereas Philip Morris, again, based on our projections, low double digits there, um, far, far away. So, without going through every single line item here, I think we're all on the same page here. I think it's fair to say that this company is growing faster than the majority of consumer staple stocks, if not in the top decile or quintile. So, how does that bore itself out in terms of valuation? Well, it is more expensively valued than most of consumer staple stocks, as well as it should be. Okay, as is appropriate. Now, one thing I do want to point out again is dividend yield. The stock continues to have a very attractive dividend yield, especially when compared to other staple stocks. Again, if we want to compare the dividend of Philip Morris to a company like Hershey and a company like Pepsi, for example, I believe that both Pepsi and Hershey, in fact, why don't we just actually pull these? I've never done a dive on Pepsi, but I might have to because it's one that I hold and it's one that I like. You see here Pepsi's current yield 3.65. Hershey's current yield 3.22 versus 3.5. So Philip Morris has a yield comparable to, again, these aren't all of the sectors here, but comparable to Hershey, comparable to Pepsi. What do we know about Hershey? It's not growing at all. In fact, its earnings, profits are going down. We see here projected 8% decline in EBITDA, 10% decline in earnings per share. If you paid attention to my last video on Hershey, you know that the company is guiding for 30 to 40% decline in earnings per share. yet it still trades at a mid threes valuation. Now, why is that the case? Well, it's because of the payout ratio. Um, it just so happens that we see here 65% for Pepsi, 58% for Hershey, whereas Philip Morris, our payout ratio is 80 in the 80s. Okay. So look, the yield being in the mid threes for Philip Morris is purely a function of the fact that they pay out such a high percentage of their earnings in dividends. In fact, if we see here, the dividend is the lowest, uh, basically at the lowest point that it's been any time in the last 10 years. In fact, in the COVID crash, you could have picked up the stock at a 7.5% yield. Woo! Even as recently as a year ago, you could have picked it up with a 5 handle on it, and it has since decreased by 2% plus. In fact, we see here that the free cash flow yield only hovering in the 4.5% range for Philip Morris, actually pretty comparable to Pepsi. And actually, Hershey is a little bit better, although the forward year is a little more tenuous. But here's the deal. Philip Morris is growing a lot quicker than either of these stocks. So through the lens, yes, the company is richly valued right now compared to history. I think that it should be priced richly. In fact, we see here that the company is on a trailing basis, price earnings basis, has really jumped up in terms of its backward looking earnings. But I think what we need to do is we need to look at all of these are trailing metrics, which isn't awesome. But the idea being that, yes, the stock has experienced multiple expansion as of late. In fact, it is trading at its richest valuation since 2018. However, I believe that the stock deserves to trade at a premium valuation, especially when compared to its contemporaries, because it has, again, market dominance in smoke free products, as I characterize it. A tobacco stock that leads in smoke free products should indeed trade with a significant premium valuation. And we see here just how significant the valuation gap is compared to our other tobacco stocks. So, that being said, are we able to? Let's take a look at this. I really don't like the way that they calculate this because it seems to never line up. Yeah, we see here price operating income. Again, significant premium there for Philip Morris. So here's the deal. I do still believe that the stock is a buy. I would still grade it as a buy, particularly for traders and investors who are looking for somewhere to hide in a uncertain market environment. I think it's pretty simple to see that it's kind of a perfect storm of variables that lead to the recent outperformance of the company. When we did our technical analysis last time, what we pointed out, very simple. What we pointed out is you kind of had these two periods here of consolidation. And then this was the previous all-time high. And when we had graded the company prior, it was like 1/3. So it was like right here. It had just broken past that area to new all-time highs. And the argument that I made is usually when that happens is pretty bullish. Well, what happened immediately after? It sold all the way down to 115. Felt kind of like a moron, right? But it traded back up, right? Each of these candles is a week. This candle here is earnings. The stock is in uncharted territory. And really, when you talk about a prior level of potential support, it's this resistance level right here. And we do see very loosely that our stock bounced off this area here before coming back. We're kind of in uncharted territory here, folks, in terms of the chart. So that's kind of the good and fun and bad and terrible part about when a company breaks out is it's super bullish and there's no telling where it can go. But it's a little bit harder to read the chart, that's for sure. So I would the only thing I would say on that is, yeah, we've experienced a pretty massive breakout, especially here. We busted through the prior all time highs and just ascended to new heights, up 20%. So I would expect more volatility at the elevated valuations here. However, the environment right now that we're in, the environment of American exceptionalism in the markets really leveling out, is one factor. You have a weaker dollar environment playing out. You have um, rotation into more value oriented stocks playing out. You have all of the things that create a bullish backdrop for consumer staple stocks, and then you combine that with the growth that the company is guiding to and seeing, and I think that it's still a good investment from here. I've already entered the position with size. For the majority of the money I invested in this company, it was at a new all-time high or near it when I did that, and it has since done well. So I will say, my conviction here is arguably not as strong as it was at $90. However, what we do see here is confirmation of the thesis playing out. So what are the risks at this level? Well, the risks are just that it's really ran pretty hot. It's ran pretty hot, and that's the main risk, is just valuation. But honestly, when it comes to stocks, I think that might be the best risk to take, especially only when the fundamentals are very solid. And I think that that's what we're seeing with this company. Is I still think that we're very early in the story here. The company has stated that their goal here is to derive 100% of their business to be smoke free. And I think with that in mind, we are very early. Okay. We're early in the smoke free product story worldwide. We're early in this company's, involvement in it. And this company is the clear and present smoke free category leader as of now. So I still think that it's a buy. I think that the stock has done well. I think it will continue to do well. However, I hesitate to, give it quite the glowing review that I did before, just because of the valuation. However, I see no problems here with continuing to deploy capital into the stock on strong pullbacks, as I do expect more volatility ahead. So yes, I do have a strong level of conviction in the stock, and it continues to be one of my top ideas for the years ahead, and certainly for a volatile 2025. So that's going to wrap it up for today's video. Again, I'm really trying to be better about this whole coming back and reviewing the previous videos and the previous analysis work. And if you missed my earlier videos or video on this stock, then please be sure to watch that. You'll get some more important context. I'll dive more into the thesis. And of course, you can, follow me on Seeking Alpha and read my analysis as well for further context. So I'll link to that in the description as well for you, so you can see, and I welcome you to do so. But this has been fun. Hopefully you've had as much fun as I have exploring it with you. And yeah, if there's things you want me to take a look at, comment, let me know. But yeah, it's been great. I appreciate and am thankful for all my viewers, and look forward to seeing you again here soon. All right, thank you, and have a good rest of your day.